Assalamu alaikum and good evening to all the students for an ACCA practice to pass session. And today is day 4. And in the last session, we have discussed about some of the key accounting standards that covers IFRS 15 and IAS 32 financial instruments. These are the standard that was widely examined by the examiner in the past papers. So right now we are going to start the new accounting standard, which is final account, which is IAS 16. The name of this accounting standard is the property, plant and equipment. So first you need to know about the property, plant and equipment is the cost, that what should be included in the cost of the property, plant and equipment. Should include the cost of purchase, then we have directly attributable cost. Directly attributable cost means any cost that you have incurred, that you need to incur in order to bring the asset into ready to use form. Third one is dismantling and site restoration. This cost should be recognized at its present value, and then there will be an unwinding of discount adjustment for this cost. This includes installation charges, any sort of professional fee, site preparation cost, then we have testing cost, handling and delivery cost. So these types of costs should be capitalized because IAS 16 says initially asset should be recognized at cost. So first time asset will be recognized at cost. Cost includes all types of the cost of purchases, all types of directly attributable costs, and dismantling and site restoration cost. We never capitalize any abnormal losses. We never capitalize any administration related cost, allocated cost. So these are the costs at which we need to capitalize the property, plant and equipment. For subsequent measurement, training costs will never be capitalized. We never capitalize the training cost. Remember this point. For subsequent measurement, we have cost model and we have revaluation model. Cost model will be based on historical cost concept, and revaluation model is based on the current cost. Current value. That is the meaning of market value. So here we can measure the asset at the fair value less accumulated depreciation, accumulated impairment loss. Okay. In the cost model, asset will be measured at cost less accumulated depreciation and accumulated impairment loss. So there is a concept of subsequent expenditures. So if you are incurring an expenditure subsequently on the non-current asset, what will be the treatment? Sorry. If we are incurring an expenditure subsequently on the asset, like we have purchased the building and then we are incurring expenditure to increase the height of the building, or there might be a painting in the building cost. So what will be the treatment of this type of cost? So for subsequent measurement, it says that if it is a capital expenditure, means the expenditure is giving benefits to the asset, then you can say that this will be considered as an asset, and all other expenditures which is incurred to maintain the asset will be recognized as in revenue expenditure. So actually, capital expenditure and the revenue expenditure, we have two things. So all revenue expenditure will be charged as an expense, and all capital expenditure will be capitalized. So you only need to see whether the expenditure you are going to incur will increase the benefit or the earning capacity of that asset or not. If it is increasing the earning capacity of the asset, then it will be capitalized. But if it is required for the maintenance, then it will be charged as an expense. Now, similarly, they said that overhaul cost will be capitalized, because whenever we are doing the overhauling, that means that we are replacing some of the parts of the asset which are not working properly. So after the overhauling, the asset is almost new, and actually it increases the useful life of the asset. That is the reason we capitalize the overall cost. So now here's a question for you guys. All of you are required to calculate the cost. Hello, is my voice is clear? Yes, okay. So you can also capitalize the borrowing cost. So now we're going to attempt this question. The first one. During the year ended 31st December 2008, Linity company builds an extension of its head office. The costs associated with the construction of the head office extension are as follows. So we have incurred the cost of 10 million to acquire the land to build the head office. We have incurred the fees for the environmental certification and building the permits, architect's fees, construction material labor cost, including unusual material, 6.6. At 30th September 2008, the date when the head office extension becomes available for use, the cost of the unused material on the site available is 0.5. At that time date, the total borrowing cost incurred on the loan which is used to specifically finance the head office extension is 0.8 million. So you need to calculate the cost of the head office. IL means impairment loss. So is it done? What will be the cost of the head office? There's a student who were talking about the historical cost. Actually, historical cost convention says that we cannot adjust the carrying amount of the asset deduct the accumulated depreciation and impairment loss. This impairment loss is recognized according to the provisions of prudence concept. Okay, it's done. So first you need to capitalize the land value, then fees for the environmental certification and building permits, yes. Architect's fees, yes. Construction material costs, yes. But you need to deduct the unused material, which is 0.5, and the borrowing cost of 0.8. By adding all these figures, we got the value of, I think it's 18.4. Is it correct? Okay, good. Okay, is it done? So the answer for this question should be 18.4, A answer. All construction related costs should be capitalized. What if the borrowing cost incurred on the loan which was used to specifically finance the head office extension, which amounted to 0.8, were not specific? If it is not specific and if it is a general borrowing, so first you need to calculate the weighted average borrowing rate if we have more than one loan. And you need to see the time period over which the construction took place. Okay, now let's attempt this question. Limited company incurred a further expenditure on the head office extension after it had been completed. Which of the following qualify as a capital expenditure? So which of the following part is the capital expenditure? So the property insurance premium incurred. So remember this point that we never capitalize the insurance of a non-current asset. Only the insurance in transit can be capitalized. Installation of a new office fixtures and fittings. Yes, it should be capitalized. Marketing cost, telling the public that the head office extension is operational. Never capitalized. Maintenance can never be capitalized. Now, the next question is at 31st December, insurance in transit means that if you have bought the asset from the other country like USA or Canada or something, and your asset is coming in the through the shipment, and you have to pay the cost of the insurance, which is called the insurance in transit. So this could be capitalized. If the insurance expense incurred during the production, will it be capitalized? No. Insurance will never be capitalized because it is the cost incurred in order to maintain the asset. So insurance will never be capitalized. Only you can capitalize the insurance in transit. Custom duties, yes. Customer duty means any sort of taxes that you have to pay, which is not refundable. Like sales tax is sometimes refundable. So if the taxes is not refundable and which has to be incurred in order to buy the asset, then it should be capitalized. Now, at 31st December 2009, the directors of the Linity company decided to adopt the revaluation model IS16. So IS16 says you have two options, cost model or revaluation model. You can select any of the model. In accordance with IS16, which of the following statement is false? So you need to identify which statement is false. In the subsequent years, the depreciation will be based on the revalued amount of the head office building as opposed to its cost. Is it true or false? So actually, it's true. Any revaluation gain on the head office building is recognized in other comprehensive income, and any loss is recognized in the profit and loss. It's true. Each component part of the head office building is revalued separately. So revaluation must be done at the same time. The residual value in the useful life must be reviewed. So this is true. Now, the concept of the revaluation model. So first you need to calculate cost, calculate the, you'll be given a cost and you need to identify the accumulated depreciation, and then it will be the net book value. And then you need to compare this with the market value, and there will be a revaluation gain or loss. Then the revised depreciation will be based on this market value divided by remaining useful life. So first you need to see at what point of time the company has done the revaluation. So there might be a case where the company is going to revalue the asset at the start of the year, yeah, at the mid of the year, at the year end. So if the revaluation was done at the start of the year, then you need to charge a depreciation based on the market value. If the revaluation was done at the middle of the year, so for the first 6 months, depreciation will be based on the old values, and for the last 6 months, so if it is related at the middle of the year, so for part of the depreciation will be charged on the old values, and part of the depreciation will be charged on the new values. And if it is at the year end, then depreciation will always be based on the new values. If the revaluation, if you are doing the revaluation, the whole class of the asset will be revalued. NBV, it's net book value and market value. New value means the market value, revised market value. Now, whenever we are going to make the revaluation, there will be two situations when we have a revaluation gain or revaluation loss. Revaluation gain will go in the equity side, OCI, or income statement. Revaluation loss will go in the income statement, or it might reduce the revaluation gain we have recognized. Now, revaluation gain will be adjusted against the revaluation loss will be adjusted first against the revaluation gain, and then the remaining amount will go in the income statement. So this amount will also be reported in the OCI. So whenever we have entered a transaction in equity, it will also be reported in the OCI. Yes, depreciated as at the original cost. So there's a question that you need to solve it. Okay, revaluation model and cost model was discussed. Revaluation must be regular. From the same class, revaluation upward will go in the equity, and OCI, revaluation loss will go in the income statement. Okay, estimates related to the depreciation is the useful life or revaluation amount, these are the estimates related to the depreciation. It will be based on, it must be reviewed. It should be reviewed annually. Regular means there must be a time period after which we need to do the revaluation. Like after 3 years, after every 3 years, you need to do the revaluation, or after 4 years, or after 1 year. So you have to decide at what time you are going to make the revaluation. Now here's the format for you guys. Revaluation at the start or mid. So first you need to calculate the net book value, then compared with the fair value, the difference will be the revaluation gain or loss. Then we need to calculate the revised depreciation and exit depreciation and deferred tax liability. So these are the points of IAS 36. Now please solve this question. Now solve this part of the question. Okay, let's start solving this question. We have a lease property having a cost of 75,000 and accumulated depreciation of 15,000. So first of all, you need to see at what date the company has done the revaluation. So starting date is 1st April 2005, and company is going to perform its revaluation on 1st October So it means that revaluation was done at the mid of the year. April, May, June, July, August, September. So revaluation was done at the mid of the year. So first you need to charge a depreciation for the first 6 months. So this is the net book value of 60,000 on 1st April 2005. So we cannot use this value because of the fact that this asset was revalued on 1st October. So first you need to charge a depreciation for the first 6 months. So 75,000 divided by 25,000. So 25 years, you got the depreciation value of 3,000 for the year. And for the first 6 months, it will be 1,500. So my net book value will be 58,500 at 1st October. That is the date of my revaluation. Now at this date, the market value of this asset is now 66,300. So there must be a revaluation gain. $7,800. So now you need to see whether we have to pay the tax on this property. So the answer is yes. However, the revaluation will give rise to deferred tax liability of 20%. So when you take 20% of 7,800, it will be 1,560. And finally, you need to make the revised depreciation based on the remaining useful life. So what will be the revised depreciation for this question? Revised depreciation will be based on the new market value, which is 66,300 divided by remaining life of 19.5 into 6 by 12. This will be my revised depreciation. It is 1,700. So what amount will be charged? Reported in the balance sheet? 66,300 minus 1,700. That will be my net book value. $64,600. 64,600. So, and in the income statement, there will be a depreciation of 1,500 plus 1,700. And in the OCI, other comprehensive income, there will be a revaluation gain of 7,800 net of tax, which is 1,560. Now I'm here. If you guys want to know any issue, if you have an issue, please do ask. Why did you divide 19.5 in revaluation? Okay. Now check this point. In the question, it says that 75,000 is the overall cost of the asset and remaining life at this point start of the year is 25. So annually we were charging depreciation of 3,000 for this asset. And in the accumulated depreciation column, it says there is a depreciation of 15,000. So 3,000 into 5. When we multiplied by 5, we got the value of 15,000. What does it mean? That the start of this year, this asset was already depreciated by 5 years. And after this, we have charged a depreciation of 1,500 for the 6 months. So up till the revaluation date, how many years that we have charged the depreciation? So it was 5.5 years. So out of 25 years, if we have used 5.5 years, what will be the remaining life? The remaining life will be 19.5. Is it done? So one of the students was asking about the revised year was not given to us in the question. That's why we just take the remaining life. Yes, we should use the revised useful life if after the revaluation the remaining or the revised useful life was given to us. Okay. What type of revaluation that goes into the all types of revaluation gains? Actually, when we make the accounting entry for the revaluation gain, the accounting entry will be asset debit and revaluation reserve and gain credit by 7,800. So this will go in the asset side and this will go in the equity side. The standard says that whenever we are going to book again the equity, that will also be reported in the OCI. So now if you have earned a gain of 7,800, then you need to pay the tax on that gain. So we have calculated a deferred tax liability by taking 7,800 into 20%. This will be 1560. The accounting entry for the deferred tax liability will be revaluation reserve debit or deferred tax liability credit by 1560. So remember this point that whenever you have got the gain or profits, you need to pay the tax on that profit. No. If you start using this value, your answer will be same, but you need to take the net book value. Now you can actually you wanted to say this when you divide 75,000 by 25, you got the value of 3,000. Similarly, when you divide 60,000 divided by 20 years, you will also get the same value, 3,000. So if you are using the remaining life, so you need to take the net book value as well. Why not deferred tax debit and tax debit? Why not tax debit? The tax related to the revaluation reserve will go in the equity rather than income statement. That's why we debited the revaluation reserve. The gain on the investment properties goes to SPL. Yes, these are separate standards. When we are talking about the property, plant and equipment, we have to follow the provision of IAS 16. So if someone is wanting to know about the investment property has a different accounting standard, which is IAS 40. So yes, IAS 40 says that the investment property gain will go in the income statement. If there is no reserve and there is a revaluation loss, you need to see the reserves only when you have got the revaluation loss. If you find a revaluation loss, then it should go into the income statement. I will try my best to cover most of the accounting standards. But right now, I want you guys to focus on. Now, there is an adjustment in the examination that relates to like property, plant, and equipment. So this is the adjustment that the normal examiners ask in, that is very simple, and it's always based on the depreciation. Like the plant is having a cost of 72,100. Its accumulated depreciation is 28,100. That's my net book value. And it says that the plant and equipment will be depreciated at 15% using the reducing value. So simply need to apply 15%, and then your depreciation is here. So can you calculate the figure? The net book value is 44,000, and taking its 15% value, we got the depreciation of 6,600. That's it. So there is a compulsory adjustment in most of the past papers. When you see there is a clear cut question that is related to simple depreciation. Now, if you have any question in your mind, now you can ask. Is the deferred tax liability going to SOFP? Yes, obviously, all assets and liabilities will go in the SOFP. All liabilities on the WhatsApp. My WhatsApp is not, my phone is off right now actually. So if you wanted to ask any question, you can ask here. Would it would go in the same caption as the current tax? No, current tax actually is reporting the current liability, but the deferred tax should be reported in the non-current liability. What if it was a straight line solution? If it was a straight line question, that you simply need to divide it with the useful life or apply the percentage on the cost. There's a question. There is, now that's the point. Remember this point, that you are owning a company, and there is a authority who is looking at you all the time. That authority is called taxation authority. And this authority sees that if the company is earning any type of profit, then you need to pay 20% tax to this authority. So this question says that we have earned a revaluation gain of, we are going to recognize the revaluation gain of 7,800. So you need to pay taxation at 20%. So that's the problem, that whenever you are earning some profits or recognizing some profits, then you need to book the taxation as well. Yeah, you can, and anyone can ask the questions on my WhatsApp number personally, or even after Friday. You can take some time of mine to take a Zoom meeting. So we can have a Zoom meeting. We can have a discussion on the WhatsApp as well. You can call me. So after Friday, but after Friday. Anyone wanted to ask any question? Now, in case of if the revaluation was done at the end. So first you need to calculate the net book value at the year end and compare it with the fair value or market value. Then you will find the revaluation gain or loss. And if there is a revaluation gain, you also need to book the deferred tax. So if there is a gain, you need to multiply it with the tax rate in order to get the deferred tax liability. That's it. So you don't need to book the revised depreciation because we have already charged a full year depreciation in the income statement. There are students who are confused about the revaluation. I'm giving you a short example to clear the doubts. Suppose the company has bought a land having a value of 6 lakh. After 1 year, company has done its revaluation, it will become 1 million. So from 6 lakh to 1 million, there is a revaluation gain of 4 lakh. And in the second year, they booked a loss. When they recalculate the fair value, it's now 4 lakh. So first it moves from 6 lakh to 10 lakh and then from 10 lakh to 4 lakh. I want all of you guys to make the accounting entries. Why sometimes in question they say they ignore tax? Whenever the examiner is asking to ignore about to ignore the taxation, that means that they don't want in this question to account for the taxation. So you only need to book the gains and losses and you do not need to adjust the deferred tax. I have shared some handouts for the practice purpose for all of you guys in the handout section. Please do download these handouts and try to solve these questions. I will share my answers by tomorrow. So the first thing is the revaluation gain. So whenever there is a revaluation gain, the accounting entry will be asset debit and revaluation gain, revaluation reserve credit by 4 lakh. And this will also go in OCI. That's my first year. Now, subsequently, when we have performed the revaluation, there is a loss on the revaluation of 6 lakh. So IAS 16 says that first you need to reverse the revaluation gain that you have already recognized in the equity. So you can see in the previous year that we have recognized a gain of 4 lakh. So you can only debit the revaluation surplus by 4 lakh, but you need to book the loss of 6 lakh. So the excess loss will go in the income statement. Are you guys getting the accounting entries? So here is a revaluation loss that goes in the revaluation reserve. It will also be reported in the OCI. This will go directly in the income statement. Now, there is an opposite case of this question in which we bought the land for 6 lakh. Initially, there is a loss on the revaluation by 3 lakh and subsequently there is a gain of 9 lakh. So you guys are required to make the accounting entries for this question as well. So now in this case, in the first year, there is a revaluation loss of 3 lakh. So as we don't have any revaluation surplus, so we have booked the loss in the income statement. Subsequently, there is a gain of 6 lakh. So you need to debit the asset account by 6 lakh and first reverse the income statement loss that was previously recognized. That's 3 lakh, and the excess loss will go in the revaluation reserve account. This will also be reported in OCI. I hope I have cleared the concept related to the gain or loss and disposal and what we should report in the OCI. What if this gain is related to the current year? We never use the retained earnings. Income statement will be credited means that we have to book the uh, income in the income statement. Okay. Now previously we have booked a loss of 3 lakh rupees in the income statement. Now when we see a gain, so standard says that whatever loss that you have booked in the previous year should be reversed. So first you need to credit the income statement by 3 lakh. So we are making this reversal in the next year actually. So in the previous year we have booked a loss, and now in the current year we are going to book a gain of 3 lakh. And the excess gain, once we have reversed the loss, the excess gain will go in the revaluation reserve account. So if you have booked the revaluation gain in the revaluation reserve account, then you need to reverse in case of the loss. Similarly, if you have booked the loss in the income statement, then you need to reverse that loss in the future years. Is it clear now? Now you guys are required to solve this question. Yes, is it done? Okay, first you need to see the land element and the building element. The land and building is having a cost of 43,000. Accumulated depreciation was not given to us, so the book value will be 43,000. Cameron revaluates land and building at the end of each accounting year at 30th September 2008. The relevant value incorporated in the financial statement is 41.8 million. The remaining life of building at the beginning of the current year is 18 million. So first you need to charge a depreciation for the current year. That will be 43,000 divided by 18. So what's the answer? 43,000 divided by 18. 2389. So the net book value will be, sorry. You have done a mistake. 36,000. It should be 36,000 divided by 18. So the amount should be 2,000. So the book value will be 41,000. The market value is now 41,800. So there will be a revaluation gain of 800. So it says ignore deferred tax. That means that you do not need to book tax liability. So simply it should be reported in the OCI. That's it. So in the income statement, there will be a depreciation of 2,000. 36,000 is the breakup of land and building. So as we all know that land is a non-depreciable asset. So we have depreciated only the building component. So that's what was discussed, mentioned here. The breakup of 43,000 is 7,000 for the land and 36,000 for the building. So this part is already discussed. Now here's a question for you guys. This part is related to the environmental provision. Journal entry for the revaluation gain will be asset debit, revaluation reserve credit by 800. So please solve this question. Property, plant and equipment company acquired on 1st of 2004. An item of the plant had a cash price of 14 million. How the plant will cause environmental damage and which will have to be rectified when it is dismantled at the end of 5-year life. The present value of the 8% discount rate on 1st April 2004 was rectification cost of 4 million. So actually, when we have bought the asset, the accounting entry should be plant debit by 14 million, cash credit by 14 million. And then we have booked the dismantling cost. So the entry should be asset debit by 4 and provision credit by 4. Remember this point that we always recognize the dismantling cost at its present value. It is the examiner's Now, examiners requirement that they have given you the present value already. Otherwise, you need to calculate the present value as well. So subsequently, this asset will now be reported at 18 million and will be depreciated over its useful life of 5 years divided by 5. You will get the depreciation. And you need to book the unwinding of discount as well. That will be based on 4 million into 8%. So it will be 0.32 in terms of million and 320 in terms of thousands. That is my unwinding of discount. So accounting entry should be finance cost debit and provision credit. 320. Depreciation will be 18 million divided by are we not going to do the calculation of 4,000 only? It will be done only when it says that when the question says that the 14,000 was already recorded and depreciated. However, no finance cost. $18 instead of 4. Why you want me to? Actually, when we are going to depreciate the asset, the whole of the cost of the asset will be depreciated. It's not only 4,000 that should be depreciated. 4 million is, according to IS 16, is a capital expenditure. It's a dismantling cost that should be capitalized. Capitalized means that it should be added in the value of the asset. So the total cost of the asset is actually 18 million, which will be depreciated over 5 years. So this is what we were studying in the first slide of this lecture, that there are 3 times: the cost of purchase, directly attributable cost, and dismantling and site restoration cost, and borrowing cost. There are 4 types of costs that can be capitalized in the value of the asset. Yeah, that's what we have done. 14 million plus 4 million, that's 18 million. The present value of 4 million. No, 4 million is already the present value. It's not the future value. It is actually already the present value that has, or the examiner has already calculated. The future value will be different and more than the 4 value. If the examiner has given you the future value, then you first need to take the present value and add in the 14 million. It clearly says that the present value on 1st April of the rectification cost is 8 million. So they have already calculated the present value. This part of the question, IS 16 says all significant components of the asset should be depreciated separately. All significant components of the asset should be depreciated separately. Now you need to solve this question. Fibrit acquired a new office building on 1st October 2014. Its initial carrying amount is considered land, building, air conditioning system. Is it done? This will you be able to hear my voice? Yes. So the right answer for this question is A. Is it clear? The right answer is A. Not clear. I-16 says that each significant component of the asset should be depreciated separately. So here when you see the land is a non-depreciable asset, but the building component is a depreciable asset. So it should be divided by 25 years. And remember this point, from 1st October to 31st March, we need to charge depreciation for the 6 months. 6 by 12. So what will be the depreciation of the building? 10,000 divided by 25 multiplied by 6 upon 12. So it will be 200. But for the air conditioning system, 4,000 is the cost, less 500 is the scrap value, divided by useful life of 10 years into 6 upon 12. What will be the amount of the air conditioning system? It should be 175. Wonderful. So 2000 will remain the same. From the building structure, we have to deduct 200, and from here we have to deduct 175. So the answer will be A. I hope it's clear now. Is it done? One five one two five? No, no. It should be 2000 plus 9800 plus 3 3725. If 500 is we got by selling, we shouldn't include as a residual value. Any amount that you receive after the end of the useful life, it's 3825, will be considered as a scrap value. So this air conditioning system is sold after its useful life. That means that any price that you are getting after the useful life will be considered as a scrap value. Please do attempt these two questions. If an entity decides to use a revaluation model, then all of its non-current assets must be revalued. The right answer is D for the first one. Why not A? A says if an entity decides to use the revaluation model, then all of its non-current assets must be revalued. All of non-current assets must be revalued. This is not the rule of IS 16. The actual rule of IS 16 is when you are going to revalue the asset, all the assets in the same class should be revalued. Now the second question, it should be valued at the fair value. There is a gain of 600. And there is a loss of 375. So the answer should be D. Head office and factory are two different assets. So you cannot adjust the revaluation gain and the revaluation loss of different assets. Because as we have discussed that the loss will go in the income statement and the gain will go in the equity. And they were specifically asking that what gain will be reported in the revaluation surplus. So in the revaluation surplus, there will be a gain that we will need to recognize in the equity. Because we have discussed that the revaluation loss will go in the income statement. Now, the new standard is IS 12. Yes. IS 12 income taxes. Wait for 1 minute. We are just going to start. And okay, let's take a break of 10 minutes. We'll start after the break. Welcome back after the break. Please write it yes in the chat box so that we can start the session. This part of the session is related to IS 12. Yes, okay, let's start the session. IS 12 says about the tax expense that the tax expense has got three components. The first one is the current tax plus increase in DTL, deferred tax liability, plus last year's under provided tax. So these are the three components of the tax expense. So whenever the examiner says you to calculate the tax expense, you need to add these three figures: the current tax plus increase in deferred tax liability means that if there's a decrease in deferred tax liability, it should be deducted. And last year's under over provided tax. So with reference to the deferred tax liability, you need to see whether the carrying amount of an asset is greater than its tax base. Carrying amount means simply the net book value with respect to accounting rules, and tax base means the net book value with reference to the taxation rules. So these two figures are just net book values, but their carrying amount means the net book value with reference to accounting, and taxation authority says the tax base for all its net book values. So the difference will be taxable temporary differences multiplied by tax rate, and you will get the value of deferred tax liability. So when you calculate the deferred tax liability, then you need to compare it with the previous year. If there is a increase in the deferred tax liability, it should be added in the tax expense. And if there is a decrease in the deferred tax liability, it will be deducted. So there are two types of temporary difference. The first one is the taxable temporary differences. Sorry, this just need to select this one, taxable temporary difference, and this one is the deductible temporary difference. Taxable temporary difference creates deferred tax liability, and deductible temporary difference creates deferred tax asset. So sometimes there might be a deferred tax asset, and sometimes it might be a deferred tax liability. Accounting says for the deferred tax liability that the accounting entry for this deferred tax liability will be income statement debit, means tax expense debit, and deferred tax liability credit. This entry will be made if the deferred tax arises because of income statement related items. But if the deferred tax arises because of the revaluation or equity related item, its entry will go in the revaluation surplus. So examiner can give you an example in the question in the examination final where you'll be given two types of deferred taxes. The first is related to the income statement, second one is related to the revaluation reserve, and in the requirement it will ask you to calculate the deferred tax that will go in the P&L. So what amount of deferred tax will go in the income statement? So you need to take those deferred tax liabilities that arises because of the income statement related items. Let me give you an example for this. Suppose we bought an asset that has a cost of 10,000. Taxation authorities has no issue if you bought the asset for 10,000. So these are accounting books. and these are the taxation books. We've charged a depreciation of 2000 and our net book value is 8000. Taxation authority charged depreciation of 6000 and the net book value is 4000. So here you can see the carrying amount in our books is 8000 and with reference to the taxation authority the tax base is 4000. Now the carrying amount is greater than the tax base with the value of 4000. But the difference arises because of depreciation expense. And depreciation expense will go in the income statement. So actually this difference arises because of the income statement item. So if the tax rate is 20%, so there will be a deferred tax of 800, which will go in the income statement. Accounting entry will be income statement debit, detailed credit. Is it clear? But if you have bought the asset for 10,000, taxation has authority has recorded for 10,000, but we have recognized the revaluation gain of 5,000. Taxation authorities never recognize the revaluation gain immediately. So in our books, the carrying amount is 15,000 and the tax base in the taxation authorities books will be 10,000. So here the carrying amount is greater than tax base by 5,000. So when we multiply it by 20%, we got the value of 1,000. So here the taxable temporary difference arises because of revaluation reserve. So its tax impact will also go in the revaluation. That's called matching concept in accounting. Similar items will be accounted for in a similar manner. Now, please solve this question through the equation. We need to calculate the tax expense through the equation. Now, the current tax expense is 2100 for this question. And says in addition to this, there has been a decrease in the taxable temporary difference by 2 million. If the taxable temporary difference is decreasing by 2 million, definitely 25% of this amount will also be decreasing. So there will be a decrease in the deferred tax liability of 400. So it will be deducted 500. Now you need to identify whether it's an under provided tax or if it is driven on the debit side or the over provided tax. So remember this point that under provided tax means that previously you have charged less tax but paid the more amount. So under provided tax is actually the prepayments will always appear on the debit side. And over provided tax means that previously we have charged the more amount but paid the less amount to the taxation authority, means the further amount that you need to pay. So that will appear on the credit side because it's a liability. So over provided tax will be adjusted. So when we deduct the figures, we got the value of 1730, 1470. I hope it's clear now. Any issue in this question? Yes, the 500 is a credit side. 500 means decreasing DTL. The accounting entry should be decreasing DTL. Accounting entry should be DTL debit and income statement credit by 500. Kindly explain under over provision. Okay. Assuming in 2019 you have recognized the tax expense debit by 10,000 and tax payable credit by 10,000. Remember this point that for with reference to the taxation authorities, the payment will always be made annually in arrears. That means that 2019 payment of the taxation will be made in the 2020. So whenever you are going to make the payments finally in 2020, the taxation authorities said that you need to pay more than this amount. So you have booked the tax previously as 10,000, but now you are going to make a payment of 12,000 based on the taxation authorities assessment. So do you have charged less amount or more amount in the previous year? Definitely you have charged less amount. That is the situation of under provided. So in case of under provided tax, the payment will be 10,000 and 2,000 will go in the income statement. So if there is a debit balance, that it means in the taxation authorities, there will be an under provided tax. And the opposite is the case for the over provided. How we get to know that the DTL is decreasing? Because it says, question is saying that there is a decrease in taxable temporary difference. So when there is an increase in the taxable temporary difference, that means the deferred tax liability is increasing. And when there is a decrease in the taxable temporary difference, that means that the value of the deferred tax liability is decreasing. Any question? So now please solve this one. Ignoring these lines. The 2.1 million will appears in the statement of SFP, but they do use it for the SOPL. Double counted. No, every transaction has actually the double impact in accounting. So tax expense debit means it will be reported in the P&L, and tax payable credit will go in the balance sheet. So for every adjustment, when you see, there is a concept of double entry in accounting. 1470 will go into an income statement as an expense. Is it done? Yes, income tax expense. Tax rate is 20%. The related tax rate is 20%. Tax rate is 20%. Now, tax expense will be 2,700 for the year, plus there is an under provided tax of 700. Talking about the DTL, deferred tax liability, 12,000 into 20% will be 2,400. Opening balance is 3,200. So there is a decrease in DTL by 800. So answer should be 2600 tax expense. Very good. Wonderful. Now solve this one. The right answer should be C. Student was saying in the previous question there is a deductible temporary difference. The carrying amount of tried assets are 12 million more than the tax base. So whenever the carrying amount is greater than the tax base, it will be a taxable temporary difference. The answer is C. Is it clear? Now, when you see in this question, the sales office had been purchased for 5 lakh. This one is accounting and this one is taxation. So 5 lakh is the price at which we have purchased. Subsequently, discovered that the defect reduced its carrying value by 400. So it decreases to 400. So when we compare it with there is a deductible temporary difference of 100. 100 into 30%, there will be a deferred tax asset of 30. But when we compare it with the building having a carrying amount of 2000 initially, then we revalued it to 2500. It will remain the same. So this deferred tax 500 into 30%. 150 will go in the income revaluation surplus. And the question specifically asks in accordance with IS 12, what is the impact of the property revaluation on the income tax expense? So if there is a deferred tax asset, the accounting entry will be DTA debit 30 and income statement credit 30. What if the carrying amount is less? Then there will be a deferred tax asset, but If the carrying amount is going less, that means there is a downward revaluation which will go in the income statement. Then it's fine. From where did 500 came? Check this point, that the building was initially valued at 2 million and now it was revalued to 2500. So there is a revaluation gain of 500. That will be my taxable temporary difference. I hope it's clear now. Yes, is it done? When we accounted building here, building was revalued upward and its revaluation gain will go in the equity. Therefore, its tax impact will also go in the equity. So it clearly, the question is asking for the what amount of the tax will go in the income statement as an expense. Okay. Now one more question for you guys. Yes, is it done? Should I solve it? Okay. The accountant at the mighty IT company produced the draft financial statements. He then realized that he omitted to consider deferred tax on the development cost. So, according to IS 38, we capitalize the development cost if it meets the criteria. That's accounting and that's taxation authority. In development cost, in 2005, development cost is 200,000 incurred and it's capitalized. Okay. Development costs are deductible in full for tax purpose. The meaning of this sentence is taxation authorities charged the development cost as an expense. So the carrying amount of the asset in the books of taxation authority is zero. Now you can see that carrying amount is greater than tax base. There will be a taxable temporary difference of 2 lakh. 2 lakh into 30%, we got the value of 60,000. So increased by 60,000. Is it clear? Very good. One more question for you guys. Yes. If the deferred tax increases, we will credit the tax account and debit the income statement. And if the deferred tax decreases, we debited the tax account and credit the income statement. Where it said the development cost is allowed in full. It's mentioned here the deductible in full. Deductible in full means it will be adjusted with the profit, means it should be recognized as an expense. JVs? What is JV? Journal vouchers? Journal vouchers are documents actually. You wanted to say journal entries. It's not JVs. Increase in detail means income statement debit and deferred tax liability credit. And when there's a decrease in detail, it will be debited in the detail account and credited in the income statement. I hope it's done now. Yes, debit in the income statement means it should be charged as an expense. So that's why we have created this formula that current income tax plus increase in deferred tax plus last year's under provided. Please write the answer of this question in the chat box. The current year's tax is 28,000. The existing credit balance in the deferred tax account is 2.5 million. And the provision required is 4.4 million. It has a debit balance of 2.4 million. That means it's an under provided tax of 2,400. And there is an increase in deferred tax liability from 2.5 to 4.4. 1.9. So it will be also be included in this figure. The final amount should be 32300. Very good. Okay, let's do one more question from the past paper. Now this is the statement. In the trial balance, there is an debit balance of 130. That means it's an under provided tax. And this one. So my tax expense should be 3330. Wonderful. Wonderful. Yes, this standard is important. Now, one more accounting standard which is important for this attempt is IS 20, government grant. The first one is the grant related to the revenue and grant related to the capital. Grant related to revenue means grant related to capital means the government grant which they provide for non-current assets. And all other type of government grants, other types of government grant will be considered as a revenue grant. Remember this point that government grant means government is providing you resources, assets to improve your business, to improve your productivity, to support you to grow. Grant related to capital can be recognized directly as a deferred credit by recognizing cash debit and deferred income credit. And grant related to asset can be recognized by debiting the cash and crediting the asset account. So these are the two allowed accounting entries for the grant related to the asset. Will it include the free marketing advice? Free marketing advice will be considered as a subsidy that is called government assistance according to IS 20. So these types of items should be disclosed in notes to the accounts. But when we are talking about the government grant, which is a type of government assistance, that means that government is transferring its assets. Yeah, it's for non-current asset. It could be tangible or intangible, but it's for the non-current assets. Now, grant related to revenue can be recognized separately as an income, or it could be adjusted with the related expense. These are the two presentations for grant related to the revenue. No, government grants will never be recognized as a revenue. It can be recognized as an other income, or it could be adjusted with the related expense. It can never be recognized as a revenue. So when the government has provided you the grants, first you need to record it in the deferred income account, which could be considered as a liability, and then gradually we transferred the liability into income statement. This is called amortization of the government grant. And the amortization will be dependent on the criteria which the government has set. But for the depreciable assets, it says that the amortization will be based on the method of depreciation through which the company is depreciating its assets. So if the company is depreciating its assets on straight line basis, then the amortization will also be based on the straight line basis. Let's solve this question. An entity receives a government grant of 6 million on for to keep the staff employed. To keep the staff employed within the deprived area. The government wants, like in situation of recession, that the company should not redundant its employees, and government is going to pay its salary expense. So this is grant related to revenue. This is called revenue grants. The company must not make the redundancy for the next 3 years. So the criteria is that you should maintain this part for the 3 years. The accounting entry at the start of the period should be cash debit and deferred income credit for 6 million. And this grant will now be amortized over 3 years. So at the end of the first year, the accounting entry will be deferred income debit by 2000 and income statement credit by 2000. So in the income statement, you will recognize a deferred income government grant of 2000. Is it clear? Now, out of this 6,000 deferred income, you have transferred 2,000 into the income statement. So the remaining deferred income value is now 4,000 in the liability. And out of which this liability 2,000 will be settled in the next year. Therefore, it could be classified as current liability, and remaining 2,000 will be recognized as a non-current liability. So deferred income should be split into current and non-current liability. So you simply need to see that how much of the deferred income will be settled in the future. How does it paid in the next year? I didn't get your question. Yes, we do have to split the deferred income into current and non-current liability. Should I move forward? How the current liability of 2,000 is paid in the next year, where it has mentioned 2,000 is not paid in the current year. It is actually the amortization of the government grant. It is actually unearned income which is being earned over the next periods. So there is no cash involvement. The cash is received in advance in the first year. Now we are transferring the liability or the unearned income into earned income over the period as we are following the criteria. So it says that you have received a government grant for the 3 years. For the first year, the amortization will be 2,000. For the second year, it will be 2,000, and for the third year, it will be 2,000. So as you have fulfilled the criteria for the first year, so this amount is your income, and rest of the amount is your liability in deferred income. Now solve this question. So these are all from past papers, questions from the past paper. So you should be very careful when you are attempting these questions, and these standards are very important with respect to the examination. Answer is D. Okay. We received a government grant on 1st October. The grant is to help fund rental costs of the factory in an urban generated area. Rental costs. So it is the grant related to the income or revenue. The condition of the grant were that the factory must be rented and used for at least 1 year. Mill House Company rented a factory from 1st July 2009 and was confident the condition of the grant would be met. So the financial year starts on 1st October. So October, November, December, January, February, March, April, May, June. So after 9 months, you have rented the place. House Company owns other factories in different areas. Which two of the following correctly reflects the accounting treatment of the government grant? Which two? So you need to select two options and then financial statement. Recognize the grant in full as other income in the statement of the profit and loss. No. Deduct the full amount of the grant from the cost of the factories in the statement of financial position. Yes, this could be done because it's a grant related to asset. Recognize the 3 months grant, like from July, August, September, 3 months grant as income and other income in the statement of profit and loss. Yes, this is right. Deducts the 3 months grant income from the factory rental expense in the statement of profit and loss. Deduct the full amount of the grant from the factory rental expense in the, this is not possible. So the right answer should be C and D. This one is will be right only if we own a factory. So it's not our factory actually. Next slide. Solve this question. Capital grant. Will the grant income be time apportioned? Yes, it should be time apportioned because we have met the criteria only for the 3 months. So you need to pay only the 3 months government grant in the income statement. Because the criteria is that you need to have a rented place of the factory. So if you don't have the rented place, then what for what purpose the government is going to pay you the rental expense? So if you are using the factory for the last 3 months only, so then the government will always support you for the 3 months only. Yes, rest of the amount will be considered as a current liability because it's a 1 year's grant, so you don't need to show the amount in the non-current liability. So whole amount of the amount. So applying the first method that shows the grant will be netted off with the cost of the asset. So value of the machinery is 3 lakh and we have received a government grant of 45,000. Entry will be cash debit and asset credit by 45,000. So the value of this asset is now having a value of 2,55,000, for which we will charge a depreciation of 20%. So 255 into 20% will be 51,000. Very good. So don't need to show the deferred income, don't need to show the current and non-current liability. Only the expense will be 51,000. That's called net approach. But when we are talking about the credit approach, the accounting entry should be cash debit and deferred income credit by 45,000. Now the asset is now reported at 3 lakhs. So you need to charge depreciation for the 3 lakh, which will be 60,000. At the same time, you need to amortize the government grant, which will be 45,000 into with the same pattern 9,000. So in the income statement, there will be depreciation expense of 60,000 minus income of 9,000. So net expense will remain the same 51,000. On the face of the balance sheet, asset will now be reported at 3 lakhs minus 60,000 and deferred income contains an amount of 36,000, out of which 9,000 will be my current liability and remaining 20,000 will be my non-current liability. Yes, if the conditions are not met, then you need to repay the government grant. So the whole of the accounting entries that you have made should be reversed. $9,000 will be shown separately in the income statement. Yes, or we can adjust this figure in the related depreciation. That's fine totally. Both the treatments are correct. But if you are charging the depreciation in cost of goods sold, then the grant will also go in the cost of goods sold. Talking about IS 38, Only the goodwill is the area which will be dealt with IFRS 3. It says there might be a purchased goodwill or there might be a negative goodwill, positive goodwill or negative goodwill. So negative goodwill will be recognized as an income in the income statement, and positive goodwill can be reported as a non-current asset. But but keep this point in mind that you cannot recognize an internally generated goodwill. Only the purchase goodwill can be recognized. Same is the case with all the intangible assets. You can recognize research and development, acquired or internally generated. So usually we never recognize the internally generated intangible assets. Only the assets which we have prepared through the research and development stage or that we have purchased can be capitalized. All intangible assets having a limited useful life should be amortized, except goodwill. Goodwill will never be amortized. Otherwise, all intangible assets should be amortized if it is having a limited useful life. Talking about the research and development cost, research means study to gain some knowledge. It will be recognized as an expense. Development is the application of the knowledge to manufacture a product or service. It can be capitalized only in the situation when you know it that this development is going to give you the benefits. If the development cost that you are incurring will give you the benefit in the future, then you can capitalize the development cost. Otherwise, it should be charged as an expense. So how you can identify whether the development cost is giving you the benefit or not? The IS 38 has set some criteria. The criteria has some very 4 to 5 important points. The basic theme of these points is if the development is going to give you the benefits in the future, then it could be capitalized. Otherwise, it should be charged as an expense. Where in the profit loss the goodwill go? Goodwill will be reported after the gross profit. You can place it anywhere in the consolidated income statement after the gross profit. Internally generated intangible assets can now not be recognized as a non-current asset. Only the purchased intangible assets or which you have developed with the research and development stage. Please solve this question. Is it done? So here you can see 1 million per month the company is incurring on the research. So 1 million month for January, February, March. So 1 million into 3 months will go in the income statement. At which date the project passed into development state. From this date, it spent 1.6 million per month until the year end 30th June, at which date the development was completed. However, it was not until 1st May that the directors of the Moston were confident. So from March and April, for the 2 months, the directors were not confident. That means this amount will also go in the income statement. And finally, when the directors become confident from the 1st May, you need to capitalize the amount. So May, June, 2 months amount, this will go on the face of the balance sheet. It is 1 month amount, sorry, for the month of April only. It's 1.6 million. Is it clear? One more question for you guys. Non-current asset. Development cost will always be considered as a non-current asset. It can never be shown in current assets. All tangible and intangible assets are actually non-current assets. AMCO company carries out the research and development in the year ended 30th June 2005. AMCO company incurred a total cost in relation to the product X of 7,50,000, spending the same amount each month up till April 2005. When the project was completed, the product produced by the project went on sale on from 31st May. The project had been confirmed as feasible and for January 2005, and the product produced by the project was expected to have a useful life of 5 years. So you need to calculate the carrying amount. That will be the cost less accumulated amortization. The cost of the asset is 7,50,000. The amortization should be 7,50,000 divided by how many years? 5 years. The annual depreciation will be 15,000, 150,000. But you need to charge the depreciation for the period of 2 months. The project was completed in April. So 1,50,000 multiplied by 2. I think we have done some mistake here. We need to read it again. In the year ended 30th June 2005, EMCO incurred a total cost in relation to product X was 7,50,000, spending the same amount each month up till April. Okay, so from 1st July to April. So July to April means 7,50,000 divided by 10 months. So this amount will be 7,50,000 divided by 10 months. It will be 75,000 for each period. Yes. Okay. The product produced by the project went into onto sale from 31st May. The project had been confirmed as feasible from 1st January. That's the important point. So from 1st January to April, you need to capitalize this amount from 1st January to April. 75,000 into 4. So this will be capitalized. So that amount is 3 lakh. So this is my capitalized development expenditure. Now we need to charge a amortization of this amount. So the amortization for this period amount will be 3 lakh divided by 5 years. It will be 60,000 for a year. So for the period of 1 month, the depreciation will be 5,000. The answer should be A. Is it clear to all of you? How it can be considered as 10 months? It would be 10 years. How come 74? Okay, let me explain to you guys. Actually, this question is saying that the year end is 30th June 2005. It will start on 1st July, on 4th. In the year ended 30th June, EMCO company incurred a total cost in relation to the project X. Now, in this current year, they have incurred a expenditure of 7,50,000, spending the same amount each month up to 30th April. So from 1st July to 30th April, they have incurred the same amount with a total cost of 7,50,000. So when you count this period, it will be a 10 months. So in this 10 months, they are incurring actually 75,000 per month on the research and development. But the project become confident or the criteria of IS 38 met from 1st January. So January, February, March, and April. So these are the 4 months. 75,000 into 4 will be charged, will be recognized as an asset. So you have completed the project in April, but your product goes for the commercial production on 31st May, and your year end is June. Now IS 38 says that you have to charge the amortization from the date you are getting the benefit. So in May you didn't get any benefit because you haven't started the production and the sale of this product. So it all started in June, so therefore we are charging the depreciation first divided by 5 and then 1 upon 12. It will be 5,000 for 1 month. Okay, so that's the concept. So this question is now your assignment. These some of the questions are your assignment. So from tomorrow we will start with some of the accounting standards and then we will work on the ratios topic. Thank you so much for your time. And if you have any further queries, you can ask me on the WhatsApp group directly or in our group. Thank you so much. Take care.